At the end of my video titled For the Love of Annuities, I mentioned that David Lau, who is the founder of DPL Financial, mentioned that if a client wanted a 7.5% return on investments back in 2004, the client needed to be invested in 50% equities. Well, that number is now 96% equities. Well, I guess I answered the question to today's video already. That sure is a lot of risk in a retirement portfolio. And I've shown you in previous videos what market downturns can do to your retirement portfolio. So in today's video, I'm going to show you how this is the reality that we're currently living in. But I'm also going to show you how you can actually mitigate risk and increase guarantees in your retirement portfolio. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Let's start by addressing what's going on with bonds. Well, absolutely nothing. Given that we're in a historically low interest rate environment, the returns being generated from bonds are close to zero. So even though the long-term treasury yield recently jumped, the overall increases in interest rates are going to be limited by the federal government, as it needs to keep its debt financing rates as low as possible due to incurring over $7 trillion in debt from the coronavirus pandemic alone. So I think it's safe to say that the interest rates will not be on the rise anytime soon. Of note, the national debt as of the end of January 2021 is approximately $28 trillion, or stated a little bit differently, about $84,000 per American citizen. Just to give you a little more perspective and understanding why the interest rates will not be on the rise anytime soon, the national debt is at the highest level since shortly after World War II. And that was actually reported in October of 2020. And the government is continuing to spend trillions of dollars in coronavirus relief. Now, the lower interest rates are not only depressing the value of your bonds, but also the significance of your bonds in your retirement portfolio by increasing the amount of risk you're exposed to from your 60% equities by as much as 25%. So to summarize, bonds are not buffering the risk in your retirement portfolio. They're not generating the returns that you need from your retirement portfolio, much less providing you the income that you need in your retirement portfolio. So is there a solution? Leave me a comment in the section below and let me know what solution you would propose to help to mitigate the higher than anticipated risk from your retirement portfolio. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit that notification bell so that you can receive notices anytime I post a new video. The answer is, unfortunately, not investing in 96% equities, especially if you're approaching retirement, as finding long-term returns for your equities will be more difficult now than it has been in the past decade. Besides, the current split of 60-40 in your retirement portfolio is projected to return 4.2% as compared to the 7.5% over the past decade. Experts are actually recommending that you invest in alternative investments in order to improve the returns in your retirement portfolio, but that can be quite risky. So what is the answer? Since bonds are not performing very well, much less buffering the risk in our retirement portfolio, why not replace those bonds with some guaranteed income, money that you cannot outlive if lifetime income, by purchasing a fixed annuity in your retirement portfolio? So in my video, The More Risk, the More Reward, True or False, I actually showed you how a retirement portfolio that includes stocks and bonds can be more productive with a fixed annuity. So I'm going to give you a little refresher, but if you want the details behind the analysis, be sure to check out that video. As shown on this graph, By replacing the bonds in your retirement portfolio with a deferred income annuity, you see how the retirement portfolio with the deferred income annuity outperformed the 60-40 retirement portfolio over the last 20 years. Of note, the current interest rate was used for the deferred income annuity in this analysis during a time period where the interest rate was much, much higher than 1% on bonds. So you swapped out 35% of your bonds, a relatively low-risk product, with a no-risk deferred income annuity and got better performance from your retirement portfolio in addition to 60% of your annual withdrawal amount of $50,000. So there you have it, less risk, more return from the inclusion of a fixed annuity in your retirement portfolio. And if that money, that guaranteed income, is lifetime income, you can't ever outlive that money. Now, if you have enough guaranteed income to cover your basic living expenses in your retirement portfolio, then you can actually be a little more risky with respect to the rest of your retirement portfolio. Now, those alternative investments are not looking as bad of an option, are they? If you're wanting to obtain a fixed annuity for the guaranteed income benefits that it can provide your retirement portfolio, along with the financial security, certainty, and happiness that it'll provide your retirement, be sure to click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up. Subscribe to my YouTube channel and share it with your family and friends. Let's get the conversation started on how you can live your best retirement while not outliving your money.